A recurring pattern throughout financial history has led to the decimation of savings for millions over the past 15 years. Astonishingly, as of 2022, the very legislative architecture is in place within the United States for this very scenario to unfold. In 2013, the nation of Cyprus awoke to a stark reality. Their banks were shuttered. Upon reopening, a staggering 47% of all deposits exceeding 100,000 euros had vanished, not stolen, but legally confiscated by the government to shore up failing financial institutions. 2 years later, in 2015, Greece implemented stringent capital controls. Citizens were permitted to withdraw a mere 60 euros daily from their personal accounts. This meant your funds were effectively frozen, inaccessible for withdrawal, transfer, or even removal from the country for months on end. Then, in 2019, Lebanese banks froze all accounts. Individuals with substantial savings found themselves restricted to withdrawing no more than $200 per week. This limitation persists to this day. 6 years later, their money lost, trapped within a failing system on 3 separate occasions, 3 developed nations, 3 instances where governmental authorities lawfully appropriated depositors' funds. This was not through taxation nor inflation, but a direct seizure from bank accounts. And here is what should profoundly alarm you. The legal framework for such an action in the United States already exists. It was established in 2010 under the Dodd-Frank Act and is known as bail-in authority. When the next banking crisis inevitably strikes, and it is indeed coming, your deposited funds will serve as the initial line of defense. Not government reserves, not Federal Reserve lending, but your own money. This is the narrative of how contemporary governments seize bank deposits, the legal justification behind it, and why your savings are not as secure as you might believe. Before we delve into this pattern, it is crucial to grasp the true meaning of a bail-in and its distinction from prior interventions. In 2008, when banks faltered, governments intervened with bailouts. These involved taxpayer funds, newly printed currency, and emergency loans, effectively transferring the bank's losses onto the public, which understandably incensed citizens. The concept of too big to fail evolved into too big to save. The political repercussions were immense. Consequently, in 2010, governments in both the United States and Europe enacted new legislation. Ostensibly, the stated purpose was to prevent future bailouts, asserting that banks should face consequences for poor investment decisions and that taxpayer rescues would cease. This sounds reasonable, doesn't it? However, here lies the critical issue. When a bank collapses, someone must absorb the losses. Shareholders are the first to suffer, naturally, followed by bondholders. But if these measures are insufficient, if the losses exceed the combined value of equity and bonds, who is next in line? The depositors. The very individuals who believed their money was safe within the bank. This is a bail-in. Instead of the government rescuing the bank with public funds, the bank rescues itself by appropriating depositor funds. Your savings are instantaneously transformed into the bank's capital without prior notice or your consent. This is permissible under the law and has already occurred thrice. Let us examine the first instance the world witnessed this unfold. Cyprus, March 2013. This serves as the foundational blueprint. Cyprus, a modest island nation in the Mediterranean with a population of approximately 1.2 million, is a member of the European Union and utilizes the euro. During the 2000s, Cyprus emerged as a significant banking hub. Russian oligarchs, European corporations, and affluent individuals alike deposited their funds in Cypriot banks. The reasons were compelling: reduced taxation, banking secrecy, and access to the Eurozone. By 2012, the banking sector in Cyprus held assets equivalent to 800% of the nation's gross domestic product, an 8-fold multiple. Its 2 largest institutions, Bank of Cyprus and Laiki Bank, had grown excessively large, far beyond prudent limits. Their investment decisions proved disastrous. They acquired substantial holdings of Greek government bonds. These bonds offered attractive interest rates, ranging from 10 to 12%, prompting Cypriot banks to invest heavily. However, when Greece encountered its sovereign debt crisis in 2010 and 2012, the value of these bonds plummeted. Greece underwent a debt restructuring, resulting in bondholders incurring losses of 50 to 70%. Cypriot banks, holding billions in these devalued Greek bonds, found themselves insolvent. Their losses far surpassed their capital, rendering them bankrupt. Yet they remained operational, as the financial world collectively ignored the severity of the losses, perhaps to avoid admitting failure. This charade persisted until early 2013. The banks required a bailout, an infusion of $10 billion for recapitalization. However, Cyprus's entire GDP stood at only $18 billion. The government simply could not afford such a sum. Consequently, Cyprus sought assistance from the European Union and the International Monetary Fund. The EU agreed to provide financial support, but with a crucial stipulation: Cyprus must implement a bail-in of its depositors. On March 16, 2013, Cypriot banks were ordered to close. It was a Saturday, and no prior warning was issued. Depositors awoke to find ATMs deactivated, bank branches locked, and a government announcement detailing a stability levy, a one-time tax on all bank deposits. The banks reopened on March 28, nearly 2 weeks later, but with capital controls in place. This prohibited the transfer of money out of Cyprus. Let us now fast forward 2 years to Greece in the summer of 2015. By 2015, Greece was deeply mired in its debt crisis, enduring 5 years of austerity measures, with its GDP having contracted by 25% and unemployment soaring to 25%. Despite these hardships, the nation remained unable to meet its debt obligations. In June 2015, negotiations with the European Union and the IMF collapsed. Greece faced imminent default, and its citizens recognized the impending crisis. They had witnessed the Cyprus situation. A Greek default would trigger the collapse of its banks, and a bank collapse would inevitably lead to the seizure of deposits. Consequently, Greeks began withdrawing their funds en masse. In a single week, between June 15th and 21st, $8 billion flowed out of Greek banks, initiating bank runs. The banks were rapidly depleting their cash reserves, and if this trend continued, they would soon run out. On June 28, 2015, the Greek Prime Minister addressed the nation on television, announcing a referendum on the bailout agreement and declaring that banks would close the following day. The banks, closed on June 29th, did not fully resume operations for 3 weeks. Upon their reopening, stringent capital controls were enforced. These restrictions were severe. Greeks could withdraw a maximum of €60 per day from ATMs. That was the absolute limit. For essential expenses like groceries, rent, or medicine, individuals were confined to €60 daily. Pensioners without ATM cards were permitted to withdraw €120 per week from a branch, requiring them to queue for hours, often in sweltering summer heat, for a meager sum to cover their weekly needs. International wire transfers were prohibited, preventing businesses from paying overseas suppliers and individuals from sending money to relatives abroad. The economy effectively became cash-dependent, and there was insufficient cash to meet demands. While Greece did not enact a direct bail-in, as Cyprus had, confiscating a percentage of deposits, they implemented a measure arguably more damaging. They rendered the money unusable. If you cannot access your savings, if your daily withdrawal is capped at €60, can you truly claim that money as your own? In practical terms, it had been confiscated. While the balance might appear in your account, its usability was non-existent. It was trapped. The capital controls remained in effect officially until 2019, a span of 4 years. Even after their eventual lifting, the Greek populace had learned a profound lesson: distrust the banks and avoid keeping your money in Greek financial institutions. Today, Greeks opt to keep cash at home, hidden in mattresses or safes, or if possible, move it abroad. Bank deposits in Greece have yet to reach their 2009 levels, 16 years later, illustrating that once trust erodes, it rarely fully recovers. The lesson from Greece is clear. Even without a direct bail-in, governments possess the power to trap your funds through capital controls, making them inaccessible and practically worthless. These restrictions can persist for years. However, Cyprus was a small nation, and Greece was struggling. One might assume such events are confined to economically vulnerable countries in crisis. Lebanon, however, has demonstrated that this can also occur in middle-income nations with well-established banking systems. Let us now examine the situation in Lebanon. Beginning in 2019, this crisis is ongoing and arguably the most severe of the three. For decades, Lebanon was referred to as the Switzerland of the Middle East, with Beirut serving as a prominent financial center and its banks regarded as robust. The Lebanese pound had been pegged to the US dollar at a rate of 1,500 to 1 since 1997, maintaining stability for over 20 years. Furthermore, Lebanon's banking sector was substantial, with bank assets representing 400% of its GDP by 2019. Yet beneath this veneer of stability lay a Ponzi scheme. The Lebanese government consistently ran massive deficits, averaging 10 to 15% of GDP annually, necessitating constant borrowing. Lebanese banks financed these deficits by purchasing government bonds, yielding 8 to 12% interest. To acquire these bonds, banks relied on depositor funds. Both Lebanese citizens and foreign investors deposited dollars into Lebanese banks, attracted by the high interest rates. Banks then utilized these dollars to purchase government debt. This system functioned as long as new deposits continued to flow in, effectively using new money to service existing debts and fund the government. In 2019, the system began to unravel. The government could no longer secure additional borrowing, and international lenders ceased providing funds. Foreign currency reserves started to dwindle, and depositors grew increasingly apprehensive. In October 2019, widespread protests erupted. The government announced new taxes, prompting further public unrest. Simultaneously, quietly, bank runs commenced as individuals attempted to withdraw dollars. However, the banks lacked sufficient dollar reserves, having lent them to the government, which had subsequently expended them. By November 2019, banks began imposing withdrawal limits. Initially informal, these restrictions soon became official: $1,000 per week, then reduced to $200 and subsequently to $100 weekly. By early 2020, many banks permitted only $50 to $100 in cash withdrawals per week. The most distressing aspect, however, was that account statements continued to display full balances, and these withdrawal restrictions remain in effect today in 2025, a full 6 years later. The banks have never fully returned the funds. The government defaulted on its debt in 2020. The currency has become worthless, and depositors remain trapped. Some have pursued legal action, while others have resorted to storming banks with weapons in desperate attempts to reclaim their own money. There have been instances of hostage-taking, with individuals driven to such desperation that they seize bank employees to demand access to their savings. In 2022, one man famously held up a bank with a firearm to withdraw $5,000 to cover his father's medical expenses. He became a folk hero, as his plight mirrored that of countless Lebanese citizens. The lesson from Lebanon is that modern banking operates on confidence. When confidence falters, banks can simply refuse to release your funds indefinitely. The government offers no recourse. The courts are powerless because the money is no longer available. The banks do not possess it. It has been lent to an insolvent government or lost through imprudent investments, leaving you merely a creditor to a failed institution. 3 countries, 3 distinct mechanisms, but an identical outcome. Depositors lost access to their funds. Cyprus experienced a direct bail-in, with 47% of deposits seized and converted into valueless shares. Greece implemented capital controls, trapping money and allowing only €60 to be withdrawn daily. Lebanon resorted to an informal freeze, rendering money visible in accounts but impossible to access. In all 3 scenarios, individuals who believed their money was secure in the bank were mistaken, and in all 3 instances, these actions were either legal or at the very least resulted in no prosecutions. Let us dissect this pattern, as it is remarkably consistent. The United States is exhibiting all the warning signs. Stage 1. The banking sector becomes excessively large. Cyprus, 800% of GDP. Greece, 300% of GDP. Lebanon, 400% of GDP. When a nation's banking sector dwarfs its economy by such multiples, the government is incapable of bailing it out should it fail. It is a mathematical impossibility. In the United States, the 6 largest banks collectively possess assets exceeding $12 trillion, representing 43% of the U.S. GDP, held by just 6 institutions. If they were to fail simultaneously, no bailout would be sufficiently large. Stage 2. Banks engage in risky investments. Cyprus acquired Greek government bonds that subsequently collapsed. Greece lent to an insolvent government. Lebanon operated a Ponzi scheme involving government bonds. Banks undertake risk because in prosperous times they reap enormous profits, and in difficult times they anticipate government bailouts, a phenomenon known as moral hazard. In the United States, banks are currently holding $500 billion in unrealized losses on their bond portfolios. The commercial real estate market is in decline. Silicon Valley Bank, Signature Bank, and First Republic Bank all failed in 2023, serving as critical warning signals. Stage 3. A crisis trigger exposes these risks. In Cyprus, it was the Greek debt restructuring. In Greece, it was a sovereign debt default. In Lebanon, the government ran out of foreign currency. Some event occurs that reveals the bank's losses to be real and no longer concealable. In the United States, the trigger could be a recession, a collapse in commercial real estate values, rising interest rates making bond losses impossible to hide, or a geopolitical crisis prompting capital flight from the dollar. The specific trigger is irrelevant. The underlying vulnerabilities are already present. Stage 4. Bank runs commence. Once individuals perceive the risk, they rationally attempt to withdraw their funds. In a fractional reserve system, banks maintain only approximately 10% of deposits as reserves, lending out the remainder. Consequently, if everyone attempts to withdraw simultaneously, the bank will fail. In all 3 preceding examples, bank runs were either initiated or imminent when governments intervened. In the United States, we witnessed numerous bank runs in 2023. Silicon Valley Bank experienced withdrawals totaling $42 billion in a single day before regulators intervened to shut it down. The infrastructure for digital bank runs, enabling fund transfers via mobile applications, makes modern runs faster and more devastating than ever before. Stage 5. Government intervention. The government steps in to prevent total collapse. However, this intervention comes at a cost, which is borne by the depositors. Cyprus. Bail-in. Deposits seized. Greece. Capital controls. Funds trapped. Lebanon. Informal freeze. Indefinite restrictions. In the United States, what form will this intervention take? The law already permits bail-ins. Section 206 of the Dodd-Frank Act empowers the FDIC to resolve failing banks by converting deposits into equity. Your cash becomes immobilized within a failing institution. The legislation is enacted. It simply has not been invoked yet. Stage 6. Years of economic hardship. Even after the immediate crisis subsides, the damage lingers. Cyprus required years to recover. Greece continues to grapple with the aftermath. Lebanon is experiencing a humanitarian crisis. This is because once individuals lose their savings and trust in banks is shattered, it is exceedingly difficult to regain. People hoard cash, businesses struggle to secure credit, and investment stagnates, leading to economic stagnation. This is the pattern. 6 distinct stages. The United States has already completed stages 1 through 4, and we are currently in stage 5. The next banking crisis is actively developing. Let us examine the specific vulnerabilities. First, the unrealized losses within regional banks. As the Federal Reserve raised interest rates from near 0 to 5% between 2022 and 2023, bond prices experienced a significant decline. Banks hold trillions of dollars in bonds, and these bonds are now worth considerably less than their purchase price. Under current accounting regulations, banks are not required to recognize these losses as long as they hold the bonds until maturity. However, if depositors withdraw funds, banks are compelled to sell these bonds to generate liquidity. Upon sale, these losses are realized, diminishing the bank's capital. If this reduction is substantial enough, the bank becomes insolvent. Silicon Valley Bank failed precisely in this manner. They had $16 billion in unrealized losses. When depositors withdrew funds, they were forced to sell bonds, realize the losses, and consequently, the bank collapsed. Numerous regional banks find themselves in a similar predicament. Second, commercial real estate. Office buildings have decreased in value by 40 to 50% since 2019, largely due to the rise of remote work. However, banks have extended loans based on 2019 valuations. There are $3 trillion in commercial real estate loans held by U.S. banks. When these properties are refinanced or sold at current market values, banks will incur significant losses. New York Community Bank narrowly avoided failure in early 2024 due to its exposure to commercial real estate. They are far from alone in this situation. Third, FDIC insurance is largely a myth. The FDIC maintains an insurance fund of approximately $125 billion. The total insured deposits in the United States amount to roughly $10 trillion, representing a mere 1.25% coverage. If just 2% of banks were to fail, the fund would be depleted. Furthermore, there are over $18 trillion in total deposits. The majority of these exceed the $250,000 insurance limit per depositor per bank, rendering them uninsured. Even for amounts below the $250,000 threshold, if a sufficient number of banks fail concurrently, the FDIC will lack the necessary funds. They would be compelled to seek loans from the Treasury or the Federal Reserve, which implies the printing of money leading to inflation. You face a grim choice. Either you lose your deposits directly or you lose their value through inflation. Pick your poison. Fourth, digital bank runs are virtually unstoppable. In the past, a bank run was a time-consuming process, requiring individuals to physically go to the bank and wait in line, introducing friction. Today, one can withdraw $50,000 using a mobile app within 30 seconds, transfer it to another bank, or purchase cryptocurrency. Silicon Valley Bank witnessed $42 billion in withdrawals in a single day, representing 25% of its deposits, vanishing within 24 hours. No bank can withstand such a rapid depletion of funds. Once one bank fails, panic spreads instantaneously through social media, prompting widespread attempts to withdraw funds from similar institutions, simultaneously signaling the end. Fifth, the bail-in law is unequivocally in place. The Dodd-Frank Act clearly stipulates that in the event of a systemic crisis, the FDIC has the authority to resolve failing banks through bail-ins. So, what might the future hold? Let us envision a plausible scenario. It is late 2025 or 2026. A recession takes hold, unemployment rises, and corporate defaults begin to mount. Commercial real estate loans start to go bad. A major regional bank announces substantial losses. Depositors panic and initiate withdrawals. The bank collapses. The FDIC takes control, but its funds are insufficient to cover all deposits. Other banks with similar exposures experience runs. 3 more banks fail within a single week. The FDIC fund is nearly exhausted. The stock market plummets by 20%. Credit markets freeze. The president declares a financial emergency. Over the weekend, capital controls are announced. Withdrawal limits are imposed, capped at $300 per day from ATMs. Transfer limits restrict movement of more than $10,000 without prior approval. International wire transfers are suspended. The FDIC declares that deposits at failed banks exceeding $250,000 will be converted into equity. This is a bail-in. If you had $500,000 in the bank, $250,000 would be insured. The remaining $250,000 would transform into shares of a bank now valued at perhaps 20 cents on the dollar. 3 times, in 3 different countries, at 3 distinct moments, depositors learned that their money in the bank was not truly theirs. It represented an unsecured loan to the institution. In a crisis, this loan can be converted to equity or frozen indefinitely. Cyprus demonstrated the legality of bail-ins. Greece revealed that capital controls can persist for years. Lebanon illustrated that banks can simply refuse to disburse your funds, leaving you with no recourse. The United States possesses the legal framework for both bail-ins and capital controls already established. The vulnerabilities are extreme, the warnings are ubiquitous, and the historical pattern indicates an impending crisis. Perhaps you have 6 months, perhaps a year, perhaps 2, but the mathematical certainty suggests it is inevitable. So what actions can you take? Firstly, understand that bank deposits are not savings. They are loans to the bank, unsecured loans. If the bank fails, you become a creditor, not a depositor, and creditors absorb losses. Secondly, avoid concentrating all your funds in a single bank. Do not keep more than $250,000 in any one institution. Diversify your holdings to mitigate single points of failure. Thirdly, maintain a portion of your funds in physical cash outside the banking system. In the event of capital controls or bail-ins, cash in hand will be your sole accessible resource. Fourthly, consider hard assets such as real estate or gold, tangible items that exist independently of the banking system and cannot be frozen or subjected to a bail-in. Fifthly, develop a contingency plan. Determine your course of action should capital controls be implemented, identify where you will transfer funds and what assets you will acquire, because once such events commence, you will lack the time to formulate a strategy. And sixthly, recognize that the government will not protect you. Their priority will be to protect the system and the banks. If that necessitates seizing your money, they will do so. Cyprus, Greece, and Lebanon have provided irrefutable proof. The laws in the United States permit it, and when the crisis arrives, it will happen. 3 times in 12 years, governmental authorities have legally appropriated depositor funds. Each time, individuals believed they were secure. Each time, they thought it could not happen to them. Each time, they were profoundly mistaken. The pattern is unmistakable. The legislation is in place. The vulnerabilities are acute, and history has unequivocally demonstrated what transpires next. The sole question is whether you will anticipate it before your money becomes trapped. If this revelation has opened your eyes to the impending realities, please subscribe. Because when the next banking crisis erupts, when your funds are frozen or subjected to a bail-in, you will need to comprehend what occurred and why. The answers are not concealed in the future, they are inscribed in the past, and I will guide you to them.